Do you know why financial system in ancient Egypt collapsed? Pyramid schemes. Oh my god. Hello everybody, welcome back. My name is Dayan, and in today's video I will be showing you how to create your own trading personal algorithm, how to use it, and what set of rules you need to have in it in order to make your trading easier, systematic, and in order to be profitable. So what is trading algorithm? Well, personal trading algorithm is basically a set of rules that you are going to be using, which will contain all your strategy and some more details in order for you to trade systematically, and in order to be able to analyze your trades, and in order to see what is actually working and which strategy is actually not working for you. The system will give you a guidance. It's like a guidebook that you will keep by your side at all times until basically you kind of learn it by heart, and you will follow it without breaking any of the rules. So what does your trading algorithm needs to have? Your trading algorithm needs to have products and markets that you're trading, basically info on all the products or the markets that you're trading, like let's say US market, German market, which exactly product is it? Is it CFD? Is it future? Is it something else? Is it a certain stock? Or whatever instrument you're trading, you need to have it in your trading algorithm. And also you need to have included contract sizes that you will be using for specific trades. Next thing your trading algorithm needs to have is trading schedule. Basically, trading schedule will give you insight into when are you the most productive during the day. After some time of backtesting, you will see when you are making the most profit. Then you need to have setups. Those will be the patterns that you will be executing on your trades. Then strategy, a detailed strategy guide basically that you will be following, just to remind you and keep you constantly reminded of what you should be doing if you ever wander off the path, and if you ever start creating your own imaginations in trading and you see some trades that are not there. So you need to have your strategy detailed in front of you, always with you, until, as I said, until you master it and until you have it engraved in your brain. But until then, just keep your detailed strategy next to your side in your trading algorithm and you'll be fine. You can have some examples of the strategy that you'll be using, like visual pictures or of a charts or something, formation that are created, so you can just identify it and compare it easily when you see it on the chart, and to know that this is the thing that you're looking for. Next, you will have a risk and money management, basically set of rules for your risk and money management. And the last thing you should be having in your algorithm is a checklist, basically just an overview of what you need to pay attention to from A to Z, or 1 to 10, whatever you want to call it or name it, and just something that is going to be a step-by-step guide for you every single day, as I've said, in order to trade systematically. Now let's head to the PC and I will give you an example of my first trading algorithm that I created myself years back, that I've used and that I've edited along the way. Basically, I don't use this algorithm anymore. I've edited it a lot. The only strategy from this algorithm that I'm still using is the key market levels, but I will show you just so you can see how visually it looks like. Okay, so we have over here, as you can see, my trading algorithm. Right? The first topic is trading products. So those are the products that I trade. So it says here NQ and DAX futures. Trading volume is 1 contract. Then I have a trading schedule. It says trade during German, UK market opening, and then US market open. Then we have a levels to trade. 1 day and 4 hours are main levels to trade. And on the small time frames, I will be looking at 1 hour, 15 minutes, and 5 minutes. Okay, indicators that I will be using are to determine the strength of the current trend only, and the indicators are MACD. The settings are default, basically 12, 26, and 9. Then RSI 14 with flat line on 50. Basically, it's just the line in the middle, as I've explained to you in the previous videos. The upper band and the lower band will be 70 and 30. The last one that indicator that I'll be using is the EMA, basically EMAs. It's 2 of them. Exponential moving averages, 20 and 50. Basically, 20 and 50 are just the periods of time that the exponential moving average is tracking. Then it says strong trend. So when we have a strong trend, what I'm looking at, MACD convergence, RSI above or below 50, and the trend above or below all EMAs. So strong trend is when the MACD is diverging, meaning, as I've explained in the previous video, indicator and trend are doing the same thing, following the same path, and are showing visually no discrepancies. Okay, so they are converging, right? RSI same, is converging together with the trend, so they go in line, and RSI is above 50. That tells me that the RSI is climbing and that the trend is strong. And it says trend above or below all EMAs. Basically, if let's say we're in a strong uptrend, then I want to see the candles above both EMA 50 and EMA 20. Or if it's a downtrend, I want to see below both EMA 50 and 20. A weakness in trend, it says MACD divergence, RSI below 50 plus divergence. So I want to see RSI below a value of 50 plus divergence on RSI as well. So those are the key market levels that I follow on which time frame, and the indicators that I use to determine is it a strong trend or a weak trend. Next we have strategy or models. So what strategy or models do I use? I trade false breaks, true breaks or breakouts, V-shape on market open, EMA 20 crossing above or below 50 EMA, combined with divergence on MACD, RSI and stochastic. I will explain one by one. False break. Place an order just below the key market level once it breaks back with a stop of 10 to 20 points. 10 points if level is strong, 20 points if level is floating. I will not be explaining you what the floating level is. However, there are different types of key market levels as well. Do not trade false breaks on market open, and 1 to 3 risk to return ratio. So what do I mean by this? False break is a standard strategy that I trade even to this day. So how do you trade the false break? As I've already explained to you in one of the previous videos, when this level, key market level, is broken, let's say here, when it starts reversing back, I will just place a order a little bit below the key market level, and I will consider it, if it reverses all the way down, I will consider it as a false break because we didn't have enough strength to stay above the level, and we reversed and we went down. My stop loss will be 10 to 20 points, which is usually going to be just a little bit above the key market level, in order to keep the small loss and to keep the risk to return as high as possible. Let's say here, if I put a 10 point stop loss, it should be somewhere, let's say here, I could be easily making like 5 to 1 return to risk ratio. So this is false break. Let's move on to true breaks. So this is the structure that I want to see in true breaks. Let's say a squeezing flag. This is one of the examples of the squeezing flag. I could have found a better one, but I don't know, I decided to put this one. I don't even remember. So I want to see squeezing into the level, creating higher lows and just squeezing this level, followed by a big pump like it happened here, staying above the level and just continuing in creating higher highs. The detailed strategy says shrinking flag formation or strong price action with smaller candles heading into the level, creating lower lows and higher highs. Check if enough fuel or catalyst to support the push. Pay attention to Monday, Friday, last hour of the market and Fed speech. Pre-market strong equals a constant higher highs, catalyst for push, and once position is open, let it run, set up a realistic take profit with a minimum stop loss of 10 or 20 points, and leave it until you get stopped on either of them. 1 to 3 risk to return. Basically, in order not to think that this was an error, when I say creating lower lows and higher highs, I mean that if the squeezing flag is going to the upwards, okay, then you need to see higher lows. But if it's the other way around, if you reverse it, you need to see lower highs and squeezing into the level in order for the breakout on the downside. It's not really worded nicely, to be honest, but I know what I had in my mind, and I was the only one looking at this algorithm, so nobody cares. Okay, let's move on. Then the next one is price action or V-shape on market open. Okay, by the way, just to clear it up, I still trade false breaks and I still trade true break. This certain strategy I'm not trading anymore, the V-shape on market open. It's relied a lot on the price action, which can be very violent at times, and you can just get stopped out easily. It says follow the pre-market closely. Look for events that will affect the index. Check before market opening how FANGs or big companies are doing. Are they up or down? Follow the market sentiment and create expectations. So basically just analyze the pre-market and analyze how the big companies are doing. Like, I don't know, if I'm trading Nasdaq, I need to analyze how Tesla, Microsoft, Google, Facebook are doing, etc. V-shaped pattern when the market is looking strong. Market opens and pulls back down, like here on this example. Give it one or two candles to go down and establish support, exactly like over here. Confirm if any key market levels are nearby, so just to give you some extra support of rebound. Check the strength of the candles. Is it a strong drawback? Like, is it a violent move like this? Place a market order near lowest touch with 10 to 20 points stop loss after it bounced off at least 2 times in the same area. Wait for reversal. Basically, market draws back really violently to the downside, but it was a, let's say, a trendy pre-market. It was some good news, or everything is green in the pre-market, so there's no much reason to go lower. People are just taking profits at the market open. So the market goes down. You see how it started consolidating over here in this area. This, when you see like 2-3 candles consolidating, and you know that the pre-market is strong and that everything is going up, this is where you enter with the minimum stop loss just below these candles here, like with a 10-20 point stop, and you are waiting for the reversal. If there's any key levels here that will support your theory, even better. If there's no key market levels, still just keep it 10-20 points and that's it. As I've said, I wouldn't recommend this strategy to beginners, especially because you need a lot of experience with price action and to know how price action works. So this is really not for beginners. This is for a little bit more advanced and experienced traders, which I was not, to be honest. Back in the days when I created this algorithm, I was not that experienced, but it still worked for me. I still used it, not that much, but I still used this strat. Okay, 1 to 3 risk to return. The next one is V-shaped pattern when the market is looking weak. You're looking for a rebound, so it's basically a buy position again. It's not a short position. The market opens and pulls down back harder than usual, like let's say here. Give it a few candles to go down and establish support. Same absolutely strategy. Confirm if any key market levels nearby. Place a market order near the lowest touch with 10 to 20 point stop loss after it bounced at least 2 times in the same area. Wait for the reversal, but note, since market is looking weak, expect only 20 to 30 points, take profit and exit right away. Preferably 1 to 3 risk to return ratio. So what do I mean by this? I mean that, let's say the pre-market is mixed, there's some mixed news, the market isn't looking that strong, and you're not really sure that the market will really bounce back hard like it did over here, and you just want to take a quick scalp. Basically, this is a scalping technique. For all you guys that don't know what scalping is, I'll be explaining it in one of the next videos more in detail, but basically it's just a short trade, quick short trade in a span of, let's say, 10 seconds to whatever, a minute or something. It can be even longer, but usually scalp trades are like very few seconds position length. So you wait for the reversal, wait for this 10, 20, 30 points to just like a quick pump to the upside and close the position. You took your 20 points, you're happy, that's it. If it reverses, you just lost, let's say, 10 points. So with these kind of trades, you need to keep very, very minimal stop losses and very tight stop losses. And the next one is EMA 20 crossing above or below 50 EMA combined with divergence or on MACD or RSI. Basically, it's just the traditional MA crossing, like when the moving average of 20 crosses 50 to the downside or the upside, you will consider, let's say in this scenario, you will consider to sell because it crossed it to the downside. And if it crosses this from the downside to the upside, you will consider as a buy position. So it says here, when the 20 EMA crosses 50 EMA above or below and indicators are showing divergence and possible trend reversal, enter a position with a 10-point stop loss. 1 to 3 risk return. What do I mean by indicators showing divergence and possible trend reversal? Well, as we spoke in the previous video, let's say we are in a short-term uptrend, okay? Because we as a day trader, we use a lot smaller time frames, like 5 minutes, 15 minutes, etc. So we are in a short-term uptrend, and then you see divergence on MACD and divergence on RSI, and this divergence is confirmed with a 20 EMA crossing 50 EMA, let's say, to the downside. So you see that the indicators are diverging, and then 20 EMA is crossing the 50 EMA to the downside. This is just an extra confirmation to tell you, Okay, so we might actually reverse here, and you enter the position just here at the crossing with a small stop loss of like 10 points and let it play out. Again, these trades are usually not big trades and you're not making a lot of points. These are scalping trades, so you tend to risk 10 points in order to make 30 points. And this is what you should be aiming for, like quick 20-30 points. If you're, let's say, risking only 5 points, then 15 points, etc. Because usually on the smaller time frames, these EMAs are not really strictly followed unless the trend is really strong. So you go in and out, like over here, you see, you break them up below and then you go above, etc. So you can get stopped out easily if your stop loss is tight. This strategy is okay. I'm not using this strategy as well anymore, but it's okay. I mean, you can test it and try it out to see does it work for you. And the last thing is the checklist. Checklist says market levels. Make sure that they are confirmed, the market reacts to them. Basically to cross-check market levels when you sit and just before you start trading, see how the price reacted to these market levels that you marked already. If you need to adjust them a bit, adjust them. Always mark key market levels from right to left. So always look for newer data, because you don't want to be following some key market levels that were relevant 1 year ago and they're not relevant anymore. Check long-term trend on a daily chart. Check short-term trend on a 15 or 5-minute chart. I still do these things, by the way. So check the long-term trend. Are we in an uptrend or downtrend? And then check the short-term trend to see what's happening in short term. Then look for trend weaknesses by using EMAs, by using MACDs, and RSI and other indicators. And then different market time openings. This is just a reminder for myself. China opens 5:30 local time, UAE time, 1:30 Zulu. Zulu is just UTC timings. Germany opens at 12 local time, my time, 8 Zulu, and then 11 in the summertime. USA opens 18:30 local time, winter time, and 14:30 Zulu, 17:30 in the summer. Then we check economic calendar. Economic calendar I check on a daily basis. Nowadays we have some very relevant reports like CPI reports, which measure inflation. Then we have job reports, which measure as well how the job market is in the US, let's say, or Germany, or whichever market we're trading. JOLT reports, jobless claims, non-farm payrolls, etc., etc. There's many different reports that you should be following, and news, and you need to know how to read them and what kind of expectations you should have. How will the market or the big money and the retail react to these news? Then number 7 is of course read news, which you should always have some kind of news channel open or terminal or whatever you're using, whichever news sources you're using. Mainstream media, of course, as we know, are not really the most reliable source of valid information, but what to do, you follow whatever you have. And then my risk and money management, 10 to 30 points of max stop loss for Nasdaq and DAX. Basically this depends from trade to trade and from setup to setup, and it says here 3 negative trades per day, less than 60 points, I pause trading. Basically, when you have 3 negative trades in a row, this is important, I didn't put it here, but in a row, you tend to become emotional, you tend to become angry, and you get all these different kind of feelings, and you don't want to trade when you're in that state. When you're trading, you need to be focused. So you need to be focused on your trading and your trading algorithm, on your setups, and how to execute it properly. You don't want to be angry, frustrated, or any emotions like that. And then it says here, negative trades of total 60 points, stop trading for the day. I've changed and tweaked rules in my current algorithm. However, yes, when I come to the certain number of trades or points, I stop trading for the day. Let's say I have 5 negative trades. That's it. I'm gonna be stopping for the day, because after that you just start revenge trading, over trading. As I've said, you do not control the emotions. It becomes very difficult to make rational decisions. And then it says never break the algorithm. Basically, do not break your algorithm, otherwise you will lose a lot of money. Specific set of rules for each strategy. False breaks. Don't trade in trendy market. Look for a channel on a daily or 4-hour chart. Basically, what do I mean by trendy market here? I mean those days, let's say after the CPI reports, or when the Federal Reserve is having some speeches and they're doing some rate hikes or whatever. After that, the market can just explode. So you don't want to trade false breaks there because it's gonna break through every single key market level. It's gonna just ignore absolutely everything and break and go above, and there's no point in trading that. Then it says true break bounce. Trade in a trendy market, look for a clear momentum on a daily or 4-hour chart, look for a strong push back with a catalyst, mostly during earning seasons, big news, etc. This is kind of the opposite of a false break. You want to trade it when there are those big movements, when there's this big news accumulating and coming up and coming, and when you see those big news and when they're finally revealed, boom, you have these explosive movements. That's when you want to trade this true breaks, which break through all these key market levels. V-shape on market open, it says if the market is trendy and hard push up or down with no reversal in the first 5 to 10 minutes, don't trade this pattern. So basically it says like if the market is super trendy, like again, if it just breaks through everything, you'll barely see those reversals. So you don't want to be caught at the bottom waiting for the small reversal just to catch 20 points when you will get wrecked and you will get destroyed by a market that's just pushing 200 points in one go. EMA 20 crossing above or below 50 EMA combined with the divergence on MACD, RSI, stochastic. See confirmation that trend reversal is very visible. Weak or strong price action constantly getting bought or sold on any touch of the EMAs. Basically, you want to have a confirmation that the trend you're trading is actually strong and the price action is depending on the direction, weak if you're shorting or strong if you're going long. And you want to see whenever it touches the EMA that it gets bought or sold instantly. Basically that it literally, if it touches the EMA, bounces right back down or up. And always follow the trend. Trend is your friend. Yeah, that's it. That's the final line that I will finish this video with. Basically, trend is your friend, and always try to follow the either short-term or long-term trend depending on the situation. Of course, we day traders, we try to follow the short-term trends, and do not trade against it if you do not see clear signs of reversal. Do not fight it, because I have seen many people lose a lot of money, including myself. I wiped accounts by trying to short Nasdaq in bull runs, etc. This is how actually you lose money. So market can always go higher or lower, so never say, oh, it cannot go lower than this. Yes, it can. So be ready and be prepared for that. And just the most important thing is your risk and money management. Have calculated risks, log them later on into your trading statistics, and that's it. Then you will analyze it later on. That being said, the next video will be about trading statistics, and we'll be covering how to create your own trading statistics, what do you need to have in your trading statistics or log, and how you will analyze it, etc, etc. So thank you so much. Don't forget to subscribe, click the like button, click the notification bell to get notified whenever a new video comes out, and let me know down in the comments below how you find the videos. Are they informative, or did you start implementing them in your own strategy, etc. Thank you so much, and have a great day.